For a look at some investing strategies for the fourth quarter in fixed income, I'm joined by Craig Bishop. He's lead strategist with U.S. Fixed Income at RBC Wealth Management. Nice to see you, Craig.
Good to see you too, Rhonda. Thank you.
So much of this fourth quarter, there's a fixation on two things, the election and the Federal Reserve meeting. I think you're probably interested to know what happens after both. In other words, how much more can we get out of monetary policy, and do we need to see something new come a new administration next year that might impact the markets?
Sure, that's a great question, because I think certainly the Fed and other central banks have kind of made a point of saying that monetary policy has kind of reached its limits as far as what they can do. And the Fed has been talking about the need for Washington to do their fair share, begin to do their fair share. So I think coming out of the election with both candidates proposing fiscal stimulus measures, which I think could have a positive long-term benefits for the economy, that'll be the big thing to watch with regard to what the Fed needs, what that might mean for policy in the economy going forward.
Would that be beneficial for fixed income investors?
I think what it will do is longer term it will be, it's going to have the potential impact of, if it does kick in and push the economy to that breakout speed of 3%, that means that ultimately rates are going to have to move up. We'll see potentially a little bit slightly higher rates, slightly more inflation, but that's probably at least a 2-year event at the most. So in the near term, I think the market's going to have to continue to focus on, look past the next FOMC meeting. There's so much fixation on what the Fed will or won't do in December, but really the message is that trajectory, long flat trajectory for rate hikes, terminal Fed funds at 2 7/8 when they're all done, which to us means that rates, while they may move higher, it's still going to be very much a lower for longer environment.
While we're on a short-term focus, just for a moment, I want to ask you about the strength in the dollar, because we continue to see a lot of strengthening. Does it change the way you view any fixed income investments when you see that?
Sure. I think what it does for us, certainly it impacts the way that we will look at emerging markets, for example, or just international investments in general. And we'll, right now with each of those, we're market weight slightly underweight in portfolios just because of uncertainty over central bank policy. So I think with the strong dollar, what that means for the Fed policy, the Fed has previously cited a strong dollar as a reason for them to kind of stand pat and not do anything. I think we'll have to wait and see if that continues to come into play going forward.
So in terms of some of the specific investments you like now, let's turn to that. One thing you're looking at is investment grade debt. Not surprising, because again, everyone's trying to get a little bit more yield in their fixed income investments. You like triple Bs. What's happening in that space? Why do you see a little bit more value there right now?
Sure. So I think you're right. The reach for yield continues, and it's something that's been going on for months now, and to the point that I think in corporate credit in general, it's kind of pushed valuations to more almost just market averages or even slightly below historical averages. So we're cautious overall. That being said, we do recognize that there will be selective opportunities, and in the investment grade space, we like triple Bs for a couple of reasons. Those companies are going to do everything they possibly can to maintain that investment grade rating. At the same time, those companies are going to be subject to less chance of merger and acquisition, an impact of that, which could take a single A or a double A down lower on the credit rating scale.
I know you're neutral on high yield, and that's probably self-explanatory. Concerned about some risk in cases.
It's risk and just valuations. I think we were so cheap back in February. We've moved to the point now, because of that rush back in and searching for yield, that valuations are really at levels that are just neutral in our view. And while we will continue to look for select opportunities there, we'd prefer to wait for things to cheapen up. And unfortunately, that may or may not happen in the very near future. And then in high yield, too, it's a focus on non-energy related issues.
And you like munis? We
do. Munis are an important part of our client base. And we see a lot of opportunities there because they're viewed as a high quality instrument, second only to treasuries really in most people's minds. And the yields right now are attractive on a coupon basis relative to other taxable instruments, treasuries and corporates, for example, and certainly after tax. And that yield advantage of munis and that high quality aspect has drawn both domestic and foreign buyers into the market, which has really been a new dynamic that we've been paying attention to.
Craig Bishop, it's been great chatting with you. Thank you so much.
Thank you very much. Good to see you, Rhonda.
I'm Rhonda Schaffler for The Street.